Yo, what's good, guys? It's your boy Wolf back with a video. Today we're going to be going over market structure, and we're going to be talking about why it's very important to understand market structure, understanding what it is, and like how to use it when you're trading. So this is like for beginners and people that don't understand market structure because it could be very confusing. It was for me in the beginning until I really try to break things down to its simplest form, and I'm gonna try my best to explain how I learned it, and be able to teach you guys in the most simplest ways as I can. So yeah, so let's talk about market structure. What is it? Market structure basically is the framework of a trend and whatnot. So it's the basis of trying to understand where price is going. So simply put, it's just the framework of price in the form of basically patterns. You'll be able to visually see where price is going based off of the structure, which, like I said, is the framework of a market. So yeah, so why is this important? It's important because it helps you identify where you are in the market. You need to know where you are in the market before you place any trades. That's just, you do like the bare bones basic of why it's important, because if you don't know where you are, you're going to be placing trades that are against you, and you don't realize, you could have realized where you are based off of understanding market structure. And the decisions you're going to be making is going to be more calculated based off of understanding where you are. So you have to understand what market structure is, and like where you are in the market. So this is a very key point. Let me go ahead and type this in. Why is it important? It helps identify where you are in the market. Sorry for me typing slow. I got this microphone in front of my face right now, so yeah. So it helps you identify where you are in the market. Okay. Now, I'm going to get into another reason to also, hold on, let me create some space right here. So why is it important? It helps you identify where the market is, and it also helps you be able to identify key levels. Let me write this before I explain. Key levels. All right. Well, what is a key level for super beginners? Key levels can be identified in a different range of things. It could be just basically, let's say, whole numbers. Whole numbers are like, let's say 1 through 100, right? Whole numbers could be significant numbers like 10, 20, 30, 40, etc., right? These are things that we kind of are drawn into based off of the actual like number, instead of like something like 13, kind of random, 53. Like, well, no, we are kind of like programmed, like just naturally, to look at whole numbers or numbers that we're familiar with, and bank numbers are kind of like that. So banks actually use a lot more the numbers as levels. So let's just say whole numbers. Whole numbers could be a key level. Another key level is support or resistance. I'm gonna just put R here. I'm gonna type it out. Resistance. And for those who don't know what support and resistance is, I'll just do a brief demonstration on that soon. Like key level, support and resistance. Let's just say we're just putting supply, demand. Sometimes even Fibonacci. And it's a key level. It's not like guaranteed. It's just a key level that your eyes should be drawn to when price gets to these areas. So they're just key levels. So it's not just one thing, it's multiple things, but I'll explain further. So we're just gonna put Fib right now, Fibonacci. So once again, the market structure is simply just a framework describing what the market is doing. So why is it important? It helps identify where you are in the market, because you need to understand that to be able to buy, sell, or even understand when not to place a trade, buy or sell. And you will be able to know that you'll be able to see where the market structures are, or even where it could be potentially going based off of identifying key levels. These are the key levels. I usually use or pay attention to support and resistance and supply and demand more than anything else. But I'll actually visually show you guys live examples and even a demonstration. Okay, so it's able to help you identify key levels. That's very important. And okay, how to use it. So this is what we're going to get into. Okay, so let me go and get to an empty area. Okay, now this is super beginner. This is something that there's so many videos on understanding market structure and how to like draw market structure or even look at it. So with any market, all right, crypto, stocks, commodities, futures, like any type of market that you're going to be trading in, if you're able to identify the market structure, you're able to trade, right? This is like, we're looking at patterns, but it's like you see it over and over again. So you need to understand that the market moves in one of three ways. Okay, it's in an uptrend, right? Super basic. The market may be trailing sideways, and this is just a rough drawing. And the market goes down. Run out of space. Okay. So understanding this, okay, that simply means that you have a 33% chance in each of these markets. You need to understand market structure to understand that, well, 33% I'm sorry, excuse me. So this 33% of the market going up percentage wise that you'll be able to make a trade versus it going sideways, which is another 30%, versus a downtrend or taking a sell or short. You got 33%. So to eliminate, because we really don't want to trade in a ranging area, so we're going to eliminate that, which means you got a 33% plus 33% of it either going up or going down. So this is going to make it 66% of you either going to sell or buy. We're not trying to trade in this range. So they'll give you kind of the upper edge, like, because you're either trying to buy or you're trying to sell, which is going to give you 66% chance of winning, just as it is with buying. We're not trying to trade this, so our probabilities increase simply because of that. Now we need to be able to identify when we're in this range or not, same as going up or down. All right, so let's start with the uptrend. Okay, this is just a rough estimate, like, just giving a very basic drawing of an uptrend. This is for beginners. Okay, so we need to understand this. The market structure of an uptrend is when price has made, say price started down here, and price is just traveling up. Price then comes down a little bit. That doesn't mean it's on a downtrend. Price broke back up, continue to go down, retrace a little bit, corrected a little bit, shot back up, corrected, continue to go up. We know that we're in an uptrend because of this. Now, how do you know exactly it is like continue to go up? Like, you see these little areas where it starts to retrace or come back. What do? How do you tackle this market? You know what I mean? To be able to understand, like, is this a true uptrend, or is it about to start to reverse? You need to identify where. Back to this key levels. The key levels, it could be price, it could be just like where price starts to come back down. You could look in the past and be able to see where price has rejected or reversed that, and maybe in the future it showed up in the charts in real time. So let's just say right here, price, just for whatever reason, right, we're just gonna keep this simple, whatever reason, starts to go down after it's just been pushing up. Price decides to come down for whatever reason. We're gonna identify that later. but price started to come down, we need to identify where this high is at this current price. What we're going to do is we're going to draw a line at this area, whatever the price is at. As the price comes down, we are just going to wait. When price starts to reverse back to the upside, we're going to draw, we're going to draw another line at where this price decided to reverse. So let's recap. Price is just trailing up. It reversed at this point, then it started going down for whatever reason. We don't need to, figure out what that is or the reason why. Just understand what's going on right here, right now. It just reversed. Okay, whatever. We're gonna line this up. We're gonna keep this for the future. Price goes down, and for whatever reason, it decided to start going back up. Now, once it goes back up, this is the important part. This is the important part. Once price start going up from here, it's going to try to retest this high that it just made. That for whatever reason, at this point, it rejected. So since it rejected, we are kind of expecting maybe if price comes back up here, it may reject again. But if it does not and continues to break past that, that's how we know, okay, we're in an uptrend. All right. So for beginners, and this is what I did to really like make sure it's clarified. I actually used to I still do this every once in a while, but I really started where I'm actually labeling my charts. And this, right, for instance, this is how I will label it. I would just put a higher low, HL, that's higher low. And when price breaks above this this area, this key level, then this becomes I'm sorry, I put the wrong thing. This is a higher low, this is a higher high. All right, cool. So this is a higher high, this is a higher low. Because once again, price has to have to make higher I didn't explain this properly, but price has to come up, make a high, then it has to make a higher low, make a higher high, a higher low. And it said that because it's like this high, and just pretend there's another high back here. This high is bigger than higher than this high. This high right here is where it was created. When price came down and it broke up, this is a higher low because this low is higher than this low. Let's just say the price started right here. Right? So this is a higher high. This is a higher low because it's higher than this low. When price broke up, this made a new high, and this high is higher than this high. So that's why we're labeling that accordingly. So since price broke above, it created a new higher high. Price came back down to correct. That means, and when it starts to reverse and break higher than this high, right here, then this became a new higher low. This is a new higher low. Right? So I'm gonna draw this little line out just to like, okay, visually see, like if price comes back down, way down here, as long as it stays above this most recent higher low, then this, wherever that lands, it's more than likely is going to become a higher low, another higher low. So once again, recap real quick. So this is a high right here. Price came down. It didn't make a lower low, so this is a higher low. Price broke up, making a higher high because it's higher than that. And then it retraced for whatever reason, and then it just found some type of support or Fibonacci, whatever key level. And then in this higher low did not, or this low did not break this higher low. So since this low continued to break past this higher high, this becomes the new recent higher low. I'm going to mark that. All right. So on and on right here. This is the higher high and this is the higher low. the newer higher low. I say recent for a reason. So same thing. A high right here became a higher high because it's higher than this, and this is higher than that. This low is higher than the previous low. This low is higher than that low. This low is higher than this low. It's really as simple as that. This is how to identify market structure. This is the market structure to the upside. This is the framework, okay, of this market. This is how to identify. It's really as simple as that. All right, so let me move that to the side. Now, ranging markets. This is the other 33% of all three markets that you're going to encounter. It's important to be able to identify this. This is ranging, consolidating, ranging. We do not want to trade this. I do not trade this because I'm not a range trader. I'm not a range trader. Once I see stuff like this happening, I'm not trading. I'm just waiting till market continues to either go up or down or break out. I'll just say let's go up or it breaks down. Until then, I'm not really trying to trade that. But you need to identify it sooner than later before you end up trying to place any trades. So then you can make the proper decision to, place your next trade or to not place your next trade. So how do you identify this? Well, visually, you can see the reasons why. Price has found some type of support where price continuously bouncing back and forth from the bottom, which is called support. It hit multiple times. All right. And it found some type of resistance. So somewhere prices came to the top, and it, for whatever reason, it's not really like breaking past. It's not really breaking past. Like the difference, as we see over here, it made a higher high and it made a higher low, continue to go up, higher high. These are making equal highs. So that is the one thing that I always say, like, all right, cool. If it's making equal, let's say equal highs and relatively equal lows, this ain't gonna be perfect, like exact price. Like it's gonna be an area. So it's either like making higher, like equal highs or equal lows. Generally in the area, in a range, and that is not a specific price that's gonna bounce off and then go up like verbatim. Like no, it's an area. If the price is in the area, whether it opens and closes, when it like breaks through and breaks back in this range, generally you are in a range. You're in a ranging, consolidating, sideways market. We not trying to trade this. So be able to identify that when price breaks up. Let's just say, for instance, right, price was going up because we know that with higher lows, higher highs, etc. And let's say that's connected, right? Let's say price is going up and then all of a sudden it made a lower high at this point, but then it never made a higher high. These become equal highs right here. And once you see this, it's like, okay, hold on now. I'm not sure if price is going to continue to go up. So I probably wouldn't be sure to take a buy until there's a break of structure and a retest and then continuation. If price does something like this, I'm going to more than likely just wait. I'm just going to wait to see if the next price section or movement is going to create a lower high, or since this is the new, let me put this right here, because this is what you're going to see in real time. So again, we're going to recap. Price is going up. We were in this little uptrend, but let's just say for this example, you were the uptrend. This is a lower high. No, higher low, higher high, higher low. At this moment, this is a higher high. Price came down. This makes a higher low because it didn't go past this low. Once price started to go up, we are expecting price to break through. If it does not, these areas right here, both of these becomes equal highs. You need to write that down and understand that. The next movements are very important. From here, price has to, let me move my arrow. Price from this moment right here, you want to see if price is going to break this higher low, make a higher another higher low, like as far as like this, let me draw this right here. Let's say if it's making a higher low, you want to see what price does after you identify equal highs, and of course on the flip side, equal lows if you're in a selling market, right? So higher low, higher low. At this point, this is what we see. And this is what we identify. When price came back up here, we know that these are equal highs. So we kind of want to chill. The prices did not continue to go up. So we want to see what's going to happen next. Once I see that there's an equal low, just like an equal high, I'm going to stay out. In this particular case, price came back right here in this zone and then bounced back up. So between this area right here, let me just all right, too much green. Anyways, but in this little area right here is like, okay, I'm able to identify that we are in a ranging market. Until otherwise, I'm gonna stay out until there's a breakout. All right, so equal highs, equal lows. And then of course on the flip side, real quick, lower lows, lower highs, lower lows, lower highs. That's how you're able to identify. And it's only when price breaks, right? So let's say this is on a downtrend when you want to short to make money. Pay attention to where price reverses. In this particular case, this area is where price reverse started going back up because it was going down. This is the area where price started to go back up. This area is a key level. Why is it a key level? We don't know. We just know and see visually that that area reversed. There may be some type of support. There may be like something we don't know. Like it could be news. It could be whatever. It doesn't matter. You can see it. Mark it up. In this particular case, that's the low. At least for this example, we're going to start with the low. When price comes up and then it start to tank and break. This is important. It needs to break the high, the low that it just made, to then mark this as a lower high. This has to break in order for this to be a lower high. Once price comes back down here, wherever it stops, it could stop like right here. You know, it can go even lower. Wherever it stops and reverses, that is where it becomes a lower low. All right. And once again, we gonna mark that because for whatever reason, that's where price started to catch itself and then start going back up. So I'm gonna mark it up. Now, what are the buyers gonna do? They're gonna try to push the price up. At some point, clearly this failed to then tank back down. So it's like, okay, cool. Let me mark that up. This becomes a lower high because when price started or buyers tried to push up, this is the highest for whatever reason in this area. And for whatever reason in this area, price decided to then tank. You can see that, but this high is lower than this high. And it just keeps on going. This is the lower low. This is the lower high. This is very important so you can identify where you are. You need to see this in order to even think about taking any sales. You need to see this before. You need to be able to identify this and be able to see this in order to take any type of buys. And this area, of course, is the ranging market. You want to identify this so you can stay out of the market. I'm not a range like trader, consolidating trader or whatever. There's some people out there that just like buy at the support and sell at the resistance. I'm not that guy. Like I'm just going to, focus on going with the trend. So, but you need to be able to see this and identify this so you can stay out the market. Okay. This is market structure right here. Uptrend right here. And uptrends have to have breaker structures to the upside. Let's say upside right here. And you'll be able to identify that by price making higher highs and higher lows. These are the basic characteristics of identifying that this is an uptrend. I'm looking for buys in this area. It's as simple as that. Conversely, downtrend, right? It's breaker structures to the downside, and it has to make lower highs and lower lows. If it does not break structure, if it does not break structure, like you got to mark this stuff up, especially in the beginning. You got to break, like, okay, found some type of resistance, right? I'm sorry, support, came up a little bit, not strong enough for as the buyers broke through. All right, cool. We are in a downtrend. And of course, we have ranging or consolidating. There's a lot of terminology, or a lot of people like to say it different ways. This is a ranging market. And what are the characteristics? I'm gonna just put generally, because it's never like just one specific price point. It's an area. General equal highs and lows. Okay, so just to recap again, market structure. What is market? This is market structure right here. We're not talking about like entries or exits or risk management. This is simply looking at, this is what we're trying to zone in. Like, this is what we're trying to identify first before anything else. When you go to the market, you need to see, am I not uptrend, downtrend, or is it ranging? If it's ranging, I'm gonna just, sit on my hands or look for another look at another instrument. All right, how do we know it's on an uptrend? We know that because we see where price stopped, reversed, and then broke through. Where price stopped, reversed, broke through. That's all we're looking for. How do we know it's consolidating? When price gets to certain areas, it's kind of making like it. You can visually see it's going. It's rejecting at the same previous price areas or zone for both sells and buys, for both support and resistance. It's like it's literally going sideways visually. These are what we want to stay out. And of course, the same thing with the downtrend. This is market structure. This is the framework. It helps you identify where you are in the market. Are you in an uptrend, downtrend, or are you in consolidating or ranging markets? It's important because it helps you identify key levels. Key levels, once again, for whatever reason, is where price reacted. You are going to figure out why a little later, or in another video actually, why price reacted at certain levels. There are key levels. There's different type of key levels. I guess I should just say, how to use it. Well, essentially, I kind of already explained that, but this is how you will use it, because you need to identify the characteristics to be able to place buy, sells, or just even stay out. Stay out of a trade, because you're staying out of trades. This is, at least that's what I'm going to preach, to stay out of trades when you realize that you're in a ranging market. Buys and sells all day, but ranging, let's just stay out. This is going to eliminate losers. It's as simple as that. Okay, let's see what else. Yeah, I think that's pretty much for this video. I may make a part 2 of market structure, because this could be very long-winded, but yeah, if you like this video, definitely give me a like, subscribe, comment down. If there's anything I didn't explain properly, I would like to go back over it. So I will read all the comments, and this is for beginners. I'm not expecting like anybody that know how to trade already to be to comment. Like, it's just really for beginners, and this is like what I use to identify market structure. But you need to know this. And so in another video, probably I'm gonna make a part 2 to this, more than likely. So I'm going to actually go through live examples, because this is what you're going to see regardless. I could show you live examples on the next video, but because this is pretty long-winded. So yeah, I'll catch you guys in the next video. Peace.